The concept of the business entity, learning objective. Explain certain accounting principles that are important for an understanding of financial statements and how professional judgment by accountants may affect the application of those principles. Accountants prepare financial statements by applying a set of standards or rules referred to as generally accepted accounting principles. Consistent application of these standards permits comparisons between companies and between years of a single company. Generally accepted accounting principles allow for significant latitude in how certain transactions should be accounted for, meaning that professional judgment is particularly important. Generally accepted accounting principles require that financial statements describe the activities of a specific economic entity. This concept is called the entity principle. A business entity is an economic unit that engages in identifiable business activities. For accounting purposes, the business entity is regarded as separate from the personal activities of its owners. For example, Vagabond is a business organization operating as a travel agency. Its owners may have personal bank accounts, homes, cars, and even other businesses. These items are not involved in the operation of the travel agency and do not appear in Vagabond's financial statements. If the owners were to commingle their personal activities with the transactions of the business, the resulting financial statements would fail to describe clearly the financial activities of the business organization. Distinguishing business from personal activities of the owners may require judgment by the accountant. Assets have three basic characteristics: economic resources, owned by the business, expected to benefit future operations. The expected future benefit may come directly as the asset is converted into cash or indirectly as the asset is used in operating the business to create other assets that result in positive future cash flows. Assets such as land, buildings, merchandise, and equipment are typical of the many economic resources that are required in producing revenue for the business. The prevailing accounting view is that such assets should be presented in the statement of financial position at their cost. When we say that an asset is shown at its historical cost, we mean the original amount the business entity paid to acquire the asset. This amount may be different from what it would cost to purchase the same asset today, or the amount that would be received if the asset were sold today. For example, let us assume that a business buys a tract of land for use as a building site, paying $100,000 in cash. The amount to be entered in the accounting records for the asset is the cost of $100,000. If we assume a booming real estate market, a fair estimate of the market value of the land 10 years later might be $250,000. Although the market price or economic value of the land has risen greatly, the amount shown in the company's accounting records and in its balance sheet would continue unchanged at the cost of $100,000. This policy of accounting for many assets at their cost is often referred to as the cost principle of accounting. Exceptions to the cost principle are found in some of the most liquid assets, that is, assets that are expected to soon become cash. Amounts receivable from customers are generally included in the balance sheet at their net realizable value, which is an amount that approximates the cash that is expected to be received when the receivable is collected. Similarly, certain investments in other enterprises are included in the balance sheet at their current market value if management's plan includes conversion into cash soon. In reading a balance sheet, it is important to keep in mind that the dollar amounts listed for many assets do not indicate the prices at which the assets could be sold or the prices at which they could be replaced. A frequently misunderstood feature of a balance sheet is that it does not show how much the business currently is worth, although it contains valuable information in being able to calculate such a value. Why don't accountants change the recorded amounts of assets to correspond with changing market prices for these properties? One reason is that assets like land and buildings are being used to house the business and were acquired for use and not for resale. In fact, these assets usually could not be sold without disrupting the business. The balance sheet of a business is prepared on the assumption that the business is a continuing enterprise or a going concern. Consequently, the present estimated prices at which assets like land and buildings could be sold are of less importance than if these properties were intended for sale. These are frequently among the largest dollar amounts of a company's assets. Determining that an enterprise is a going concern may require judgment by the accountant. Another reason for using cost rather than current market values in accounting for many assets is the need for a definite factual basis for valuation. The cost of land, buildings, and many other assets that have been purchased can be determined. Accountants use the term objective to describe asset valuations that are factual and can be verified by independent experts. For example, if land is shown on the balance sheet at cost, a CPA who performed an audit of the business would be able to find objective evidence that the land was measured at the cost incurred in acquiring it. On the other hand, Estimated market values for assets such as buildings and specialized machinery are not factual and objective. Market values are constantly changing, and estimates of the prices at which assets could be sold are largely a matter of judgment. At the time an asset is acquired, the cost and market value are usually the same. With the passage of time, however, the current market value of assets is likely to differ considerably from its historical cost. As you will learn, for some assets, we adjust the amount in the balance sheet as the value changes. For other assets, we retain historical cost as the basis of the asset in the balance sheet. First, assume you have owned your home for 10 years and need to report the value of your home to the city assessor for real estate tax assessment purposes. What information would you provide? Second, assume you are planning to sell your home. What type of information would you provide to potential buyers? What ethical issues arise in these two situations that the objectivity principle helps address? A limitation of measuring assets at historical cost is that the value of the monetary unit or dollar is not always stable. Inflation is a term used to describe the situation where the value of the monetary unit decreases, meaning that it will purchase less than it did previously. Deflation, on the other hand, is the opposite situation in which the value of the monetary unit increases, meaning that it will purchase more than it did previously. Typically, countries like the United States have experienced modest inflation rather than deflation. When inflation becomes severe, historical cost amounts for assets lose their relevance as a basis for making business decisions. Accountants in the United States prepare financial statements under an assumption that the dollar is a stable unit of measurement, as is the gallon, the acre, or the mile. The cost principle and the stable dollar assumption work well in periods of stable prices, but are less satisfactory under conditions of rapid inflation. For example, if a company bought land 20 years ago for $100,000 and purchased a second similar tract of land today for $500,000, the total cost of land shown by the accounting records would be $600,000 following the historical cost principle. This treatment ignores the fact that dollars spent 20 years ago had greater purchasing power than today's dollar. Thus, the $600,000 total for the cost of land is a mixture of two sizes of dollars with different purchasing power. Many countries experience prolonged and serious inflation. Inflation can undermine the stable currency assumption. Accounting rules have been designed in some foreign countries to address the impact of inflation on a company's financial position. For example, Mexican corporate law requires Mexican companies to adjust their balance sheets to current purchasing power by using indexes provided by the government. Because inflation is significant, the indexes are used to devalue the Mexican currency, pesos, to provide a more transparent representation of the company's financial condition. Liabilities are financial obligations or debts. They represent negative future cash flows for the enterprise. The person or organization to whom the debt is owed is called a creditor. All businesses have liabilities. Even the largest and most successful companies often purchase merchandise, supplies, and services on account. The liabilities arising from such purchases are called accounts payable. Many businesses borrow money to finance expansion or the purchase of high-cost assets and pay for them over time. When obtaining a loan, the borrower usually must sign a formal note payable. A note payable is a written promise to repay the amount owed by a date and usually calls for the payment of interest as well. Accounts payable, in contrast to notes payable, involve no written promises and generally do not call for interest payments. A note payable is a more formal arrangement than an account payable, but they are similar in that both require the company to make payment in the future. Liabilities are usually listed in the order in which they are expected to be repaid. Liabilities that are similar may be combined to avoid unnecessary detail in the financial statement. For example, if a company had several expenses payable at the end of the year, for example, wages, interest, taxes, it might combine these into a single line called accrued expenses. The word accrued is an accounting term communicating that the payment of certain expenses has been delayed or deferred. Liabilities represent claims against the borrower's assets. As we shall see, the owners of a business also have claims in the company's assets. But, in the eyes of the law, creditors' claims take priority over those of the owners. This means that creditors are entitled to be paid in full, even if such payment would exhaust the assets of the business and leave nothing for its owners. Owner's equity represents the owner's claims on the assets of the business. Because liabilities or creditors' claims have legal priority over those of the owners, owner's equity is a residual amount. If you are the owner of a business, you are entitled to assets that are left after the claims of creditors have been satisfied in full. Therefore, owner's equity is always equal to total assets minus total liabilities. Owner's equity does not represent a specific claim to cash or any other asset. Rather, it is the owner's overall financial interest in the entire company. The owner's equity in a business comes from two primary sources: investments of cash or other assets by owners, earnings from profitable operation of the business. Decreases in owner's equity also are caused in two ways: payments of cash or transfers of other assets to owners, losses from unprofitable operation of the business.